Hawaii bill would regulate insurer climate risk through licensure. A newly introduced bill in Hawaii would expand how climate risk is regulated in the insurance sector, moving beyond disclosure requirements and into underwriting, investment practices, and licensure oversight. Senate Bill 2452, titled the Climate Friendly Insurers Act of 2026, would require certain property and casualty insurers operating in the state to align their underwriting and investment activities with science-based climate mitigation targets. While the bill remains at an early stage, it illustrates how climate risk is increasingly being addressed through insurance supervision rather than traditional environmental regulation. From disclosure to supervisory authority, under the proposal, insurers exceeding $10 million in direct property and casualty premiums written in Hawaii, or otherwise determined to pose heightened climate-related financial risk, would be required to report both financed emissions linked to their investment portfolios and insured emissions associated with underwriting fossil fuel-related activities. These disclosures would be subject to annual certification by a company's chief executive or chief financial officer. More significantly, the bill would direct the state insurance commissioner to prohibit covered insurers from underwriting or investing in new fossil fuel projects after July 1, 2026. Existing exposure would be subject to a phased withdrawal through 2035, supported by interim benchmarks and transition planning requirements established through regulation. Licensure, enforcement, and market access. Compliance with these requirements would become a condition of maintaining an insurance license in Hawaii. The bill outlines a range of enforcement tools, including administrative penalties tied to insurer profits, increased licensing and renewal fees, restrictions on dividend payments and executive compensation, and potential license suspension or revocation for repeated violations. Penalties collected under the proposal would be deposited into a newly created climate-friendly insurer special fund intended to support climate adaptation and resilience initiatives, including programs benefiting low and moderate income communities. The proposal also grants the insurance commissioner authority to require corrective action plans, mandate additional reporting, and engage third-party reviewers to assess compliance. Why this signals a broader shift? Although geographically limited and politically uncertain, SB 2452 reflects a broader regulatory trend. As climate-driven losses contribute to higher premiums, reduced coverage, and insurer withdrawals from high-risk markets, insurance regulators are increasingly positioned as financial stability gatekeepers. By tying underwriting behavior and investment exposure to licensure, the bill highlights how climate risk is beginning to intersect with near-term regulatory oversight, capital allocation, and market access decisions. Even if the proposal does not advance, it offers an early view into how some states may test insurance supervision as a tool for managing climate-related financial risk. For insurers and industries dependent on large-scale coverage, the message is less about immediate compliance and more about direction. Climate risk is moving deeper into the operational mechanics of insurance regulation, with implications that extend beyond any single jurisdiction. You've been listening to Sustainability Soundbites by Environment+Energy Leader. For partnership opportunities, please reach out to our team.